Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ali Selby, and today we're very lucky to be joined by Neuberger Berman's Gabriel for his thoughts on an area of the market with really favourable supply-demand dynamics right now. Thank you so much for joining us today, Gabriel. It's awesome to have you here in Sydney.
Thank you so much for having me, Ali. It's a pleasure to be here as well.
Firstly, without any jargon, is it possible you could take us through the different areas of the private equity market?
Absolutely. I would broadly segment the private equity market into three main areas. First would be primaries. So this is where a general partner or a GP raises a fund from LPs or limited partners who provide the capital for the GP to raise a fund and to subsequently deploy that fund into a portfolio of companies. So that would be the first main area of the private equity market. The second is what I would call co-investments. So this would be a situation where the fund has an opportunity to invest into a company that is too large for the fund to absorb on its own. So it needs to seek external capital from co-investors to help them step up to such large transactions. And the third broad area of private equity would be what I call secondaries. So this is broadly further segmented into two other categories called LP secondaries and GP-leds. On the LP secondary side, it is really investors providing liquidity to LPs who wish to exit from a fund before the end of the fund life. And for the GP-led continuations, this is really the GP taking some of its high-performing assets and moving it into a continuation vehicle to give those assets some additional time to accrete value and to find an optimal exit outcome.
And within those three areas, where are you seeing the biggest supply-demand imbalance today?
Sure. I see it from broadly two angles. The first being financing. Right? As we all know, we are living in a high interest rate environment, which is vastly different from the environment that we had navigated over the last 7 to 10 years. So with financing getting more expensive and leverage becoming harder to procure, as some of these banks have stepped away, for these sponsors to get some of these deals done, they got to put in a larger equity ticket. And this is giving rise to the opportunity to do more co-investments, simply because the debt financing markets are not able to provide that same quantum of leverage as they might have done so over the last 7 to 10 years. The second key area of constraint that I see is really around the exit environment. And as we all know, IPO markets are subdued. There's a lot of volatility in the market. So sponsors are having challenges in terms of exiting their investments. So I think there are some, I would say, players or some solutions that folks like us could actually potentially provide. So this is in the form of partial recaps. So we're coming in to buy a minority stake in a high-performing company and allowing the GP to retain the majority stake and to ride the next 3 to 4 years to eventual exit. And the difficult exit environment is also creating opportunities for GP-led continuation funds, because as you can imagine, if a fund is at the end of its fund life and there's some assets remaining in the portfolio, but the exit environment is not optimal to sell those assets, but the GP greatly believes that these assets have additional runway to go over the next 3 to 4 years. So they might choose to move some of these assets to a continuation fund, and therein lies the opportunity for secondary buyers to capitalize such vehicles and take advantage of the current market conditions. So that is how I see some providers of capital sort of playing in today's market environment.
Is it possible we could go a little bit more granular? Is it maybe an example of where you're seeing that supply-demand imbalance at work today to better illustrate that opportunity that you're seeing?
So without going to two specific names, we see what we call multiple midlife opportunities. So this is us taking a minority stake in a company which a GP had already owned for a period of time. And as a very practical consideration for the GP to raise its next fund, it would need to show some distributions in its prior fund. So a natural way to do that is to exit some of these companies. But if the exit environment is tough or they're not getting the valuation that the market is giving them, therein lies the opportunity for someone like us to come in and acquire a minority stake in some of these high-performing companies, and as a result, get exposure to co-investments which we would otherwise not have exposure to in the past. So that's what we call a midlife deal, and that is a significant proportion of the deal flow that we see today. A lot of these opportunities are actually originated by us. So this is us understanding the portfolio of the GP and proactively reaching out to create such opportunities for us to have a win-win situation, frankly, between the GPs and ourselves.
What kind of returns would you typically expect from those midlife opportunities?
Yeah, look, we typically still underwrite them to standard private equity returns in the buyout space, so north of a 20% IRR or north of a 2x multiple of capital. But with these midlife transactions, the fact is, the general partner or the GP has owned these assets for a number of years. It's unlikely that they'll hold it for another 5 to 6 years from the point of our entry. So we do see this as a potentially shorter duration strategy, but still underwritten to the same multiple of capital. So there is that opportunity to actually potentially get higher IRRs if some of these deals get exited before that typical 5 or 6 year holding period.
Okay, well, thank you so much for your time today, Gabriel. It was awesome to have you on the pitch.
Well, thanks for having me.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.